Welcome to our CFP exam prep discussion focusing on beta, a crucial concept in investment analysis that frequently appears on the exam. Beta measures systematic risk, telling us how sensitive an investment is to market movements. Let me break this down in a way that will stick with you during exam day. Think of beta as a dance partner following the market's lead. A beta of 1 means the investment moves exactly like the market. When the market goes up 10%, the investment also goes up 10%. Now, here's where many candidates get tripped up. A beta of 2 doesn't mean double the return, it means double the sensitivity to market movements. So, if the market moves up 10%, an investment with a beta of 2 would move up 20%. Let's go deeper into negative beta, which often confuses test takers. An investment with a negative beta, say negative zero point 0.5, moves in the opposite direction of the market, but with half the magnitude. When the market drops 10%, this investment would actually gain 5%. This is why gold and certain hedge funds are sometimes sought for their negative beta characteristics. A common mistake I see candidates make is assuming beta measures total risk. Remember, beta only captures systematic risk, the kind you can't diversify away. It's specifically measuring market risk, not company-specific risk. Another frequent error is thinking beta predicts future returns. Beta is historically calculated and describes the relationship between an investment's past returns and market returns. Here's a practical example that often shows up in exam questions. Consider 3 investments. A government bond might have a beta near 0, meaning it barely responds to market movements. A broad market index fund would have a beta of 1, moving in lockstep with the market. A leveraged technology ETF might have a beta of 1.5, amplifying market movements by 50%. When tackling beta-related questions on the exam, watch out for this trap. Questions might present a scenario where you need to calculate expected returns using beta. The formula is crucial here. The expected return equals the risk-free rate plus beta times the market risk premium. Many candidates forget to add the risk-free rate or misplace the beta in the equation. Understanding beta's limitations is also important for the exam. Beta assumes a normal distribution of returns and a linear relationship with market returns. In reality, markets can behave unpredictably, especially during extreme events. The exam might test your knowledge of these limitations. For better retention, connect beta to real-world applications. Portfolio managers use beta to adjust portfolio risk. A conservative client nearing retirement might prefer investments with betas less than 1, while an aggressive young investor might seek higher beta investments for potential outperformance in bull markets. Remember these key points. Beta measures systematic risk relative to the market. A beta of 1 means market-like movement. Higher beta means more volatile than the market. Lower beta means less volatile. Negative beta means inverse movement to the market. Zero beta suggests no correlation with market movements. Practice questions involving beta calculations and interpretations regularly. Pay special attention to questions that mix beta with other risk measures or portfolio management concepts. The exam loves to integrate multiple concepts into single questions. Understanding beta thoroughly will serve you well beyond just passing the exam. It's a fundamental tool in portfolio management and risk assessment that you'll use throughout your career as a financial planner.